Hey everybody, hey traders, Chris Pulver here. Welcome back to an earnings masterclass. We are wrapping up the month of January with, again, this week from January 29th to February 2nd, 320 companies reporting earnings, including all the big ones, all the Mag 7 and top 10 stocks, which the market caps are going crazy. We got Microsoft eclipsing 3 trillion along with Apple. We have advanced micro devices, we have semiconductors, AI, all the hype that was very similar to dragging the market higher in 2023 is doing the same thing as we melt up even higher in 2024. Now, we have FOMC on Wednesday, the 31st. We have non farm payroll on Friday, February 2nd. As we get into February, next week, February 5th through the 9th, we have over 1,000 companies reporting earnings. The broad market awaits. That's what I have here on the bottom. I mean, the consensus is right now we're seeing that the largest mega cap companies in the world are just doing what they do best. They're making money, decent profit margins, not a lot of competitors. The broader market that's been underperforming, possibly a chance to see the broader market step up. Now, what could derail that would be a hawkish message from the Fed this week. We could possibly see some quick corrections, some volatility. February might come in with a contraction. Maybe the overwhelming majority of companies out there are still going to underperform, and that guidance moving forward is enough to kind of put a dent in, or at least pause where these markets are going with these large mega cap companies dragging it higher. So what I want to take a look at is these are some of the big expectations this week. Google earnings per share at $1.59, revenue $85 billion. Microsoft 277 earnings per share, revenue $61 billion. AMD, I mean, the revenues are crazy, like off the chart, right? AMD is a top 10 company now, $6.12 billion. Apple 118 billion dollars. Meta $39 billion. Amazon $165 billion. Just ridiculous revenue marks for these companies. But again, that's what they do best. Energy stocks, 90 billion for Exxon Mobil, 50 billion for Chevron. Some interesting plays, totally different dynamic and sector as well. So I wanted to highlight some of those. Let's get into Google and Amazon, Meta as well. I mean, the earnings comes out for those companies on the actually February 1st. So after market on February 1st, we have Meta, we have Amazon, we have Apple. And I'm interested to see, if that pushes the market higher into the week or after the Fed message, if there's more volatility, we are certainly going to find out, but I'm excited to play those. So I'm going to look at some positions on Meta, Amazon, and Apple today. And then for Exxon and Chevron, I would take a look. I think I like Exxon Mobil better. There's a big range trade I could possibly take advantage of. Chevron's been a bit more of a downtrend. So let's do this. Let's talk about Meta, Amazon, Apple, and Exxon Mobil. So let's start with Meta. Let's go into the charts here. So Meta is up to all-time highs. We eclipsed the highs from November of 2021, and we've had 3 or 4 weeks of just really nice price action to the upside. Expected move for the week is $18.51. Let's see what that translates into for a percentage. I'm using my option slam software here. This is META. And 1851, let's find out what that is as a percentage, and I'll see what this average is for the actual earnings reports. So 6% up to 11%, 20%, 20%. Average is around 15. I'm going to go a little bit more conservative and say let's go 14% of a $401 stock and see what that translates into. And of course, it all just is based on how I can price out a buy trade, a sell trade. I like to trade options with my earnings plays. I'm essentially directionally neutral, and I'm looking to see if the market can surprise to the upside or downside. So if we're looking at an average of around 14.5% and a $401 stock, currently the price is 401.55. That's an expected move of $58 during earnings. Now get into the weekly average. We're looking at 1851. That's a huge discrepancy. Huge discrepancy. If the market only moves $18, I need to make sure that the way I'm trading this is going to be something around an $18 move. If the earnings print is expected to be $50, well, what I'd love to do is get the pricing for an $18 move and have the market move $40 to $50 as we've seen with earnings and make this a blowout type trade where we have a lot of potential. So that's the good thing about Meta is we have a lot of upside potential if it's a big surprise up or down. This stock got absolutely crushed in 2022, as did a lot of tech stocks, but it's absolutely been gangbusters to the upside in 2023, excuse me, and in 2024. So if I go into, let's say the average has to be above 14 to 14.5%. I'll just say that, okay? So 14.5%. Let's go into the earnings history. And we have a -1 that gets all single digits. So that one doesn't count. And if you see me do these videos for the masterclass, I'm doing the same thing quite a bit. This is part of my process of trading earnings reports. So this one doesn't get to double digits. 8 doesn't get the double digits. This one gets to 14 and a half and stays there. And then 5 days later gets to 16. That one counts. That's right around expectations though. So that's, 14% we said is about a $50 move. 19 to 23, that one does the job. This one's negative 24. That one does the job. 5, that one does not do the job. 15 to 17, that one does the job. Negative 24, that one does the job. Not quite there and not quite there. So I have 1, 2, 3, 4. I'm finding this a lot with these earnings seasons. I have 5 that do the job and I have 5 that do not. So it's a bit of a toss up, but obviously what I'd be trying to play and price out is the surprise of the upside. So I will be looking at a trade on Meta. It's probably going to be something along these lines where if I look at a 401, that's the current price. I could look at a long 401 or let's just say a 405 to the upside and then a 400 to the downside. What I'd like to see is if this thing is capable of going, 425 or beyond. So maybe, I mean, a big blowout move would be, 450 to the upside, and a big blowout move to the downside would be roughly 350. That's right at the average around 14.5%. Okay. So the way I'd position for this would be and I typically trade options with a lot of earnings reports. So I would do a bull call spread up here and look to see if it can blow through the highs. And I do a bear put spread down here and see if it blows through the lows. So my worst case scenario is price stays in the middle and I don't have that that exceeded movement to the upside. So my risk, might be $7 to $10. I can look and see what it prices out to be, but I'll save that for the trading room. Um, but this is what I'm going to price out. I'd like to take a trade on this. I'd like to see if we have a big surprise to the upside or downside. I really don't care. I just want to see if there's enough volatility post earnings, and even 5 to 10 days after earnings. If I give myself enough time in the trade, that this goes up to 440 or 450 and gives me the run that I'm expecting to. So the one thing that's a little alarming is the average weekly ATR is 18.51, but the earnings expectation is nearly $50. That's a big difference. So like I said, I need my earnings strategy to basically be priced in around $18 to $20, and anything beyond that would be the nice surprise. Okay, so that would be Meta. Let's go into what's next for the week. If I do Meta and then I do Google and Amazon. So Google is trading at 151.97, just above, just a whisker above these all-time highs. We could eat up the last 3 weeks of rally. We could blow the highs off again. I do have a trade already in on Google. This is the trade that I'm doing. I'm doing it's a reverse iron condor is the fancy option trade for it. That's the strategy. But essentially, I'm looking at this. I'm looking at 155. If we're above that and we're above 170, I can clear out max profit around $15. My risk is 589. My profit's $15, which gives me a net of 911. That is a pretty good position. Let's say that I hit that max profit. If I make $9.11 on an initial risk of 589, I'm clearing 154% on that position. That's not too shabby. All in all, for me, this is about a 1% risk right here on the contracts that I'm trading. So I look at like a 1.5% payoff if I'm correct, give or take. Again, trade that math, do that 100 times, have a win percentage of 60+%, right? So it's just trade by numbers, trade by math, keep it simple, and just keep doing the thing, keep doing the process, right? That is Google. Let's talk Amazon. Amazon, I own the stock. This is one of the large mega caps or Mag 7 stocks that I'm in and bullish on and want to continue to see it do well. I measured this out earlier. I think you may have seen this in the previous video. But if I take this move right here from this low to high, and we actually have this as a head and shoulders. So if this is a break of the neckline, left shoulder, head to neckline, right shoulder, there's 2 ways I can measure this. I can take this, measure it from, let me delete this for a second. So either we have this continuation up to all-time highs on Amazon. I still don't want to let go of the stock. I own the shares around around $95 to $100. I've added more in on this pullback at 130. So I like Amazon. I like it long term. If I want to play something, directionally neutral for earnings, I would just do something short term. But longer term, I'm going to take my shares and continue to own them and look for all-time highs to be matched. Think about this. Google's at all-time highs. Meta's at all-time highs. Amazon is not. Microsoft at all-time highs. Apple at all-time highs. Amazon is not, right? I'm saying that because I'm driving the point home. I think Amazon of the Mag 7s will have some room to catch up and still get to those upside levels. Amazon AI talk was not really heavy in 2023 like it is now. They're starting to speak a lot more about AI, the web services space, the computing space. To the upside, there's another 19% or so on Amazon to get to the upside. I would certainly take anything that looks pretty good for even an overvalued kind of bubble-esque stock. But this could be the blow-off move where this forces traders to continue to participate with what the average investor is doing. Everyone's buying Apple, everyone's buying Nvidia, everyone's buying Netflix, everyone's buying everything that's Mag 7 because it seems safe and it seems large and it seems like it can't fail. At some point, it will. At some point, we'll have a nasty correction. This high concentration of mega cap stocks like this is concerning. But right now is enough, and it did it all in 2023, is enough to drag the markets higher. It is, and it's been doing it because the majority of the stock market has been underperforming, which is why I go back to the slide over 1,000 companies next week. That is the majority of the stock market, right? We have 6 or 7,000 publicly traded companies. When you have an earnings print of over 1,000 companies, we're going to see what the broader market is doing. Is it positive earnings? Is it negative earnings? And if it's negative earnings, it may not be enough to really reduce the rallies we've seen, but it's going to basically be like the bucket of cement that's going to be, Apple's going to stick its feet in and Meta's going to stick its feet in. It's going to drag those down or make it heavier for those rallies to continue. But if it's good and we have a broad market rally, then sky's the limit and we'll just see another melt up. And maybe this first quarter for 2024 is all about just same as what we saw in Q4 of last year, which is holiday rally, good things, better economic factors for the US. Things are looking brighter. The recession talk is going down, but it's probably not going to be that easy. We might have a blow off run where it's like, wow, look at that. The S&P is up 10%, 12%, 15%. I don't think it's going to continue to sustain that necessarily for the rest of the year. But like I said, I'm not calling the top. I think if we blow off the top and the S&P gets to double digits, I'm hoping I can follow along and beat the benchmark, right? The way I trade options, the way I trade equities, I'm trying to use some leverage where if this is up 10%, I'm hoping my portfolio is up 15 to 20. Right. And I can do that through individual stocks because we have individual stocks that are up for the year, 18 to 20%. I looked at this earlier in a previous video. Year to date, we've got a lot of companies that are in that, 15 to 20% level. That is outperforming the benchmark by 400 to 500%. Right. So individual companies are doing really well. The issue is it seems difficult as a technical trader to buy all-time highs and be happy with that. So I think if you're buying right now, I still like the idea of protection because you never know if we're going to have short-term volatility. You never know if we have this geopolitical tension stuff that's going to take hold and push the market down a little bit in the short term. But right now, if the melt up's going to go, we're climbing the wall of worry. We're putting the all the worries behind us a little bit. That resilience in the U.S. with a little bit of better data and optimism coming out of China, I think we have global risk on for right now. So that's really my talk for today to kind of wrap up the month. I want to look at Exxon really quickly and Chevron. So let's look at XOM and CVX. So XOM. This is the range I was talking about. We had a nice little pullback. I've just put a big Fibonacci on here from low to high. We're hitting that 23%. I will say this on Exxon. If we break back below fresh lows, we're likely grinding down to the 38%, which is below, $90. To the upside, if we hold this 23% and get back to the highs, we're trading at 104. We could get to 120. So what is this average move? About $5. Okay, about $5 on a weekly basis. If I go into earnings here, looking at XOM, what's the expected move? Let's do the calculations. Hopefully, this is like a 5 to 10% move. Average earnings history, 2.7. That's a little on the low side. So it's $100 stock. Only looking for like a $2 to $3 move. I don't think that's going to be enough for me to position this and be excited about it. So yes, we could have a surprise, but not based on the averages that I see. If we have a 2.7% move and the average move is 4.92 for the week, let's do the math. So 0.27 times 104, a 280 move. The earnings report is actually less exciting than the weekly average. So I'm going to say no on XOM. Now, I would say this: if we're back in the middle, let's say earnings comes out and prices here, I might look at some trades where I can sell above and I can buy below and I can trade something somewhat neutral and make on, but I just don't think the earnings play is something I want to focus on. And then CVX right here for Chevron. Same type of situation. You can see this one has some pretty strong support. There's a nice pocket and demand level down here around 140. If this structure ends up going higher, then there's good upside potential. As far as this larger swing, I can do the same type of thing I did in Chevron, which is let's start at this low from 2020. Let's drag it up to current levels. And where are we sitting? We're sitting around that 30% pullback. Probability wise, I see this happen quite a bit. We actually had, if we took this high and pull back and retest the high, that's fine. But I think there's going to be some consolidation in here. There might be a broadening pattern, but I'd be more likely to see if we have solid earnings and oil prices going to the upside. Guess what? This starts to break. This starts to head higher, and I look for even Chevron and Chevron and ExxonMobil both to start getting into some bullish territory. Now that being said, let me take a quick look at oil before I make a decision on doing some stock plays around those energy companies. So here's U.S. oil. We're trading at 77.91. If we go to the daily chart, I've had this drawn on my charts for the entire year. If we break this trend line, oil's up, and it certainly seems to be hanging in there. I told traders this a couple weeks ago. If you just want to take a buy position somewhere in here around the right-hand side of the trend line, around 72.50, take a buy position and then wait and see if we get another chance to buy lower and move that cost basis down. But if you bought it here, you're getting some upside potential. I think that continues to go higher. There's supply chain issues. There's Red Sea issues. Obviously, geopolitical tensions is been happening now for the last couple of months. So energy stocks could just go up because of geopolitics, because of supply and demand. Technically speaking, I said this last year. I think oil finds lows around 60, 65, and then has resistance around 90, 95. We're probably in a big range on oil. But there's just so much news and noise that comes out because of it. We just got to be careful. But I think oil to the upside looks pretty good. Higher prices could translate into better earnings and higher prices in those stocks like Exxon and Chevron. I know that's a lot of information, but guess what? We're wrapping up a great start to the year. Things are pretty exciting. A lot of news ahead. FOMC Wednesday, non-farm Friday, earnings coming out with all the big stocks, and 1,000 more companies reporting next week from February 5th through the 9th. So never a dull moment in the markets. That's why I love this stuff. And if you have any questions, let me know. You know how to find me. See you soon.